he came back from the extreme position he took earlier by trying to balance the situation we're faced with. Because agreeing with you a little bit, we understand that there will be an alternative to doing this. It is possible that we're addressing key fiscal issues, and clearly the CBN itself and the monetary policy agree, like basic fiscal issues that are at the bottom of the whole of it. We will take them out. We may not necessarily have to go this way. Immediate action that will possibly curb this pressure and keep us on track. Only for us, the negative side, which is the effect on the capital market that we have seen. Within the yesterday and today, we are seeing serious volatility in all the markets that shows that possibly the way markets are reacting today are in terms of what we call expectations, which is what drives market, is negative thus far. And we hope that if this trend is, we can only hope that this trend is not sustained. That the capital market operators' expectation becomes positive in the long.
All right. Okay. So just back to the point. So you believe that it is positive.
But there are positive that negative.
And capital market negative.
The capital negative.
Monetary
policy management, why from their perspective, it is like you said. I for example have reservations about the possibility of the iron source putting downward pressure on the volatility on the exchange rate, which is the original intention, and the final goal should be price level. And we saw the inflation, the September inflation result that was recently released today. Practically, we've seen a 100 basis point increase compared to August. Which
let's just backtrack a bit so that we can take it systematically. So let's look at each of the markets. Okay. Yeah? So let's say the equities market. Yeah. How has the equity market reacted to this development?
The equity market has been bearish basically all month, and that trend has continued. The good for now is that it did not, the rate of decline did not increase. That might be certainly as much because of inactivity as it is any negative bash to what happened with the MPC on Monday. So the effect is not necessarily wholesome for our bread and butter market, but hasn't been as alarming as it could have been. I mean, we haven't seen losses of 2 or 3%, which has happened in the past when, for instance, some of the actions the actions to clean up the bank.
Okay, but there are two issues here. One is how has it reacted, and how you reckon it will come to react.
If you allow me to come in,
go on.
To help my like he said, basically we will possibly say the volatility of the effect on the equity market has not been as big as we expected. But unfortunately, we dimension it against starting that happened yesterday. We saw the first bank results coming out, third quarter results coming out a lot more fantastic. Fortunately, the market went down, and we could just imagine that in good time, if a first bank result hit the market, it could change the whole story. Unfortunately, we saw a continuation in the downturn. I'm sure that could a little bit help us to dimension what the impact could be. And we have to understand the fact that the market trend may obviously continue in terms of what the effect should be.
Sorry, please, we want to be specific.
When you is it May because May is better. What do you think? It's wood.
I think I just look at the fundamentals of the market, and I see so much value.
May, but we expect that there is likely to be fiscal activities that could make the whole thing look good. And we must understand
fiscal be specific so that people will remember we're talking to a wider audience.
The executive, the government are putting together our policy measures that are likely to be hitting the system soon. One, we've seen the MTEL that shows a commitment.
What's the MTEL? Break it down.
Medium-term expenditure framework and fiscal strategy of the government.
No, that's long term, or that's
it's not long term, but we must.
Yes, it's relatively long term.
And the expectation what drives the market is expectation. What we need to see is this vision where the people who play market begin to see that there is seriousness in the system.
No, but one of the reasons why we're having is that there seems to be some level of confusion in the market, because once you have an MPC meeting and you come up with MPR rates of 9.25, and a couple of weeks after, you have an emergency MPC meeting and readjust. Now, that doesn't sound like consistency. That sounds like a knee-jerk approach. So what you have, and the perception is that there's a bit of confusion, that the guys are confused, and then investors generally are confused. So the question I'm asking, so how do you expect the equity market, will trend, between now and the end of the year? Sure.
Let me just comment. I look at like what just to on the back of what I said about the largest bank in the country, one of the largest stocks in our market, First Bank, coming with very good earnings result for the 9 months to December, despite the fact that they had to do some write-downs to their balance sheet. But over and above the write-downs, double-digit growth for their bottom line. Excuse me. I'm very optimistic that this fourth quarter, towards the end of the year, next month, December, we're going to see an influx of institutional investors looking at the underlying value and saying, I have to take a position. It might not be as large, but an influx.
Why do you think they do? MPR is 12%.
Yeah.
Zero risk.
Yeah.
Why do I need to take? Do you understand? Why do I need to take that? Why do I need to take that risk? Because one of the things that you see with international investors, you have a situation where the exchange rate is under pressure. So it's almost like some pot that is about to go, like a pressure cooker that is about to go. So it can go. It might not. It might, or it might not go. Now, then on top of that, I'm now coming to a market and invest in the equity market that, for all you know, between the beginning of the year and now, has been burning downwards. So I'm an international investor looking in. Why would I want to invest in the
That's why I was particular about it being institutional investors. People who want to take longer term positions will look at the fact that you have a major.
But not the term. Sorry, that term, long term. Yeah. Over the last 3 years, has been defined across the world. It's been defined across the world. You want to say something about it?
Yeah. If we look at that question, we have to understand the fact that the kind of yield or return that an average international investor wants in any market, imagine as that, is almost non-available anywhere else. Even in the rules, in the same.
I think we have a slide in that regard. I don't know if you can show us
so
that
even
slide.
In the same wagon we are talking about currently, 5%, the bond market yesterday was 15 over 16%, and those are on the back of the fact that if we don't see a lot of inflow to that market, we must understand that the basic reason why there are cautious activity on the part of foreign investors in this market is only risk profile of the economy. Can that change? If you answer that question, or will it change? Does it look like there is a possibility? If there is a possibility that we could see, or they could perceive that there is likely to be a policy shift from the part of the government, even the monetary move, the ingenuity behind the decision to shift the MPR to 12%, one, to protect the foreign reserves from continuous depletion, which is the only hope we have. If the international economy go bust, could make any right-thinking person, the foreign investors to begin to look at the fact that the economy, the stock, blue chip stock in Nigeria is highly valued compared to.
Okay, so what I hear you say, so that we can also take comments from what I hear you say is that you believe that on the equity side that there is an upside. Okay. There's upside on the back of this, that there's an upside. So where we believe
to be found.
No, I mean everybody believes that the market is based on intrinsic values and that value. But what we're saying is that between now and the end of the year, that there's a strong possibility that there might be a rally and prices might go. Is that what I hear you say?
Yeah.
Okay. Dari, I don't know if you can hear us. I don't know. We'll just pause for a minute and then take questions if there are questions from staff that are watching us. Dari?
Very loud and clear, and a few questions have already started coming in.
Okay, but we can't see them here, so if you can just tell
yes,
us.
I'm just going to read one out from Anne Omezi.
Yeah.
This is the increase in the MPR and the attendant corridor rates. What is our tactical response as an organization to protect our flagship product, the GCN, from erosion by bank competition?
Will you
Yeah,
both mind?
Okay, I think it's a valid point, and it's one of the things that we are taught that we would discuss. But what we are trying to do was to try to situate our minds first and foremost, to understand the thinking behind the CBN, where they took the actions, and if actions they were going to continue to trend, i.e., could we be able to recharge a yield call on the back of actions that they are taking. Now, but from what we gather and from what we've seen from the actions that they've taken, it's very, very clear that they are willing to do what it takes to protect the naira and to curb inflation, to try and keep inflation at as close to single digits as possible. Now, your question about how it affects our flagship products that are linked to the money market rate, it's very clear that every time NPR moves, we have to move with NPR. We have to reprice. Now, what it means in essence is that it just puts us under some significant challenge to find investment outlets, that can match the kind of returns that we're looking at, So that's why I start questioning about the equities market. Questions I also wanted to ask, and I guess maybe people might comment, is also the potentials for trading, in fixed income market. But what you see is that over the last maybe 3 to 4 months, we've seen increased volatility in the fixed income space. And on the back of volatility associated with fixed income, then that means in essence that you can trade. You understand? I mean, there are opportunities, there are arbitrage opportunities in that space. So back to the point about how it affects our flagship products, which is the GCN. What does that? It means that we would have to start looking at opportunities, to trade in that fixed income space, to look for arbitrage opportunities, because with this, there's a lot of fear. There's a lot of fear, and where there's fear, there's also opportunity. So, I mean, that's what I think. I think that we would need to clearly readjust our rates. It might not, the jump in the rates might not be as high as the NPR. The jump in the NPR, because like you said, it's still early days. We wait to see how things reset, because to a certain degree, even though there's a jump in NPR, but what you tend to see is that the market has actually taken into cognizance that the cost for credit, is higher than what was perceived by the CBN. Because when credit is not generally available, what you tend to see is that if there's credit, people will typically have to pay a premium for it. So I think to a certain degree, the market might have marked the market, but as we over the next couple of weeks, we actually know where the market is. But in terms of how we are going to be utilizing the GCN funding that we get, it's very, very clear. There is increased opportunity in the fixed income space. We have to go down and take advantage of the opportunity. It also goes for our Sapphire product as well. Because one of the things that we have is that if you look at the analysis of the projection, we have projected a yield of 8%. For the Sapphire fund. Now with this movement, what that does is that it creates a window of opportunity to actually go out and grow that base, that customer base, because we have the instruments to invest in to return yields of over 14%. With the same type of risk that promised most of our investors. So I think to a certain degree, we do have the products in-house to be able to mitigate this new development, and actually make money in the process. I don't know if you have any comments, Shambaya, on that.
Just to add that some of the like 20-year bonds are being priced at yields at up to 16%.
16.75%.
So it's closer to 17. So those who are holding, of course, their prices have gone down. They've taken a hit. For anybody with some liquidity, which DCN has given to us to varying extents, it also presents an opportunity. I don't know if Deepo and Wale are available now so that they can tell us what, with your permission, what their impressions on the on the bond market is.
Are you guys there?
Deepo, Wale?
Okay, Wale has actually requested for the mic to be passed to him. So I'm going to try to see if more media is fine on his side. Wale, can you say something?
What about Deepo?
Deepo hasn't signified any intention to participate, and I can't put him on the attendant list. However, I think Wale may have a problem with his microphone, so we will want him to send a chat. Wale, if you can me, send a chat of your comments, some questions, and read it out for everybody to hear.
Any other questions, Darren?
There's a question about forwardly looking at the NPR. It says something like, when are we going to be comfortable that we will not have another hike that will lift cross 15% before the end of the year?
Good question, and I'll kind of modify that question somewhat. So let's talk trends for a minute. So, Fisher, what's your take on trends, interest rate trends between now and the end of the year?
I think interest rates are going to remain very much firmly double digits. If you look at even before this pronouncement, the pronouncement of Monday, some of the maximum lending rates to corporates on the interbank market was as high as 23%. For some of the figures released by the CBN on the activities of banks to designated companies, prime was as high as 24%. Even if, let's not forget, right, we were discussing just before we came on, so to speak, that there's another MPC, scheduled MPC for November. Even if in this MPC, the PR is pared back, and that is not likely. We already have very high interest rate regime. So one way or the other, that is going to continue to the end of the year. That's my take.
We actually have only one more MPC coming up to the end of the year. I'm very sure it will be difficult for the MPC committee to move from 12% to 15%, from 12% to 15% at that next MPC meeting. However, if we begin to think from the perspective of the CBN and the MPC, considering their position and disposition to keeping the inflation environment stable to the mean low, below double digits, and then viewing that vis-a-vis the recently released inflation rate figure for September, which is now 10.3%, a 100 basis point increase from what it was in August. It justifies. I'll say it justifies the fact that the expectations that the MPC committee and the CBN continue to reiterate about the potential threat to inflation persist. And we have not seen such an effect which we are expecting, and we are not totally seeing minimum wage being fully implemented, and we have not seen a couple of other things that they kept mentioning are potential threats to inflation, and the volatility in the exchange rate environment. So to succeed after this one, we will likely see additional increase.
So that 15%.
The 15% to be tough, but there is likely to be a little bit of uptick. The end of the year.
Okay, on the issue of trending interest, let's just hold that thought for a minute. We'll come back to it. What's changed?
I think the NAV was under, again, just, it's a similar situation. Right now, the spread not between the black market and the official WDAS rate, the spread between the interbank market and the official rate is 10 naira. This is largely precedented. It's holding the official rate at 150, banks are trading at 1 by the last market. So it does not, sadly, we don't see the stability in the naira that that CBN was probably hoping for. The present naira persists despite the mop-up of liquidity. So I see the naira losing. I think with action taken, it probably won't boil over, but the naira will continue to slip against the dollar.
So what's the prediction for December, between now and December, where exchange rate?
The official rate will probably go closer to that 160 at which the banks are trading right now.
Unofficial?
The unofficial will probably maintain it's been maintaining about 5 naira spread on that. So we're looking at an unofficial 165, 167.
What about you?
Yeah, I'm going to be a dissenting voice, but not largely, not the largest. My dissension or contraction to ensure is going to be in the value is quoted. What I would rather say is that the volatility will actually be sustained on one market in terms of pricing. We're going to see a lot of volatility in the interbank and the BGC market, because at the official market, the CBN has proven yesterday and the day before that it's going to stand ready to ensure that at least at the official market it contains price at 150.
Yeah, but they also said that they will not protect naira.
That is I would say that is a statement of condition, not that of action, as shown by what they did yesterday and the day before. They WDAS that auction 2 days ago. The CBN pumped into the market for the first time in the last 6 months, and all the demand that the market that was in the market, $509 million.
I think the average before then has been 700. They didn't do anything extraordinary. Correct me if I'm wrong, for sure.
I'm coming. There's reason. The reason that is one. They also took 200 million the interbank market on that day, according to media reports, and sold 200 million in addition outside the WDAS to the interbank, so that they can they can suppress the pressure on the interbank, as well as ensure that the official rate is at 150. In fact, on that they achieved an official rate of 150 on the mark at the official market. But CBN are taking some other actions that shows that is likely to put a lot of pressure on the interbank, on the BGC, and on the prime market ultimately. 2 memos were issued between yesterday and today that restrain importers, largely importers of petroleum subsidies, from seeking their forex needs from the official market. It is not training them totally, but it asks for all sorts of documentations that are likely to make it cumbersome for an average importer to go to the official market. So this guy we have to look for other way. Also, it restrains all repatriation of income.
Wait. Just pause for a minute, because I think that's a major development. Because if they have to look for other ways, what are the other ways?
The interbank market and the DDC market.
Can they meet the demand?
What will happen is that prices will be skyrocketing in those markets. Why what will they do?
So what you have the situation, then isn't that artificial then?
See, there's going to
because the valuation that you're getting is that the rate you're getting is very artificial.
Very.
Okay, but what's the implication of that?
The implication is to heighten risk perception of the economy. It's also going to heighten the speculative tendencies that will put a lot of pressure on even the official exchange rate. So
put it in the figure, because we have a question from so quickly, where I said 161.
Yeah, it's going to be sustained at 150, but the bank rate could reach as high as 165, while the official should be doing 170, 180. I mean, sorry, the BBC and the parallel market could reach as high as 170, 180.
Right, okay. Let's just pause for a minute. Dupe, let's just quickly take Dupe.
Hello, there's a question from Modupa Mujota. It's a text, so I'm going to have to read it out again. It says, in the wake of this price adjustment, where OBD, call and overnight rates have responded to the MPR, it is evident that credit rates will rise, and in the first instance, bond issues will be affected. Given our
What
focus
issues
on
will
this
be
market,
affected? Okay.
Yes.
Yeah, go on.
given our focus on this market niche, what implications will it have on our public sector activities? How can we reasonably mitigate income reduction based on our year-end projections?
Okay. That's a good question. One of the things that we when we go and we talk to executive governors of the state and commissioners of finance about doing raising sovereign debt for them is that, one, what we are looking at is long-term debt. I believe that the kind of actions that we're seeing now, I think, are more short-term in nature. That, in fact, if you even look at it, you see it's more knee-jerk than anything. It's going to be an easy sell, because what you also have is a situation whereby, on the back of the fact that those sovereign instruments have to be repriced based on MPR, it now makes it more attractive for banks to lend straight to straight to those governments, you know. But the one advantage that we have is that, to a certain degree, you know, yes, the banks can lend to them, but most banks typically can't go that long term. Do you understand? They can't fix rate. They still have not been able to be comfortable with the yield curve to fix rates for as long as 7 years. Because on the kind of interest rate regime that we're beginning to see with CBN, nobody knows where the interest rate will be in the next 7 years. You know, because we have a situation whereby at the time we had uncertainty in Libya, Tunisia, Egypt, you know, which typically affected oil prices. So you typically will say oil prices are probably at their peak, you know, and you begin to see stability in these regions. You would see the price of oil will begin to come down. In fact, I think 2 weeks ago it came down. So what you would see is that our reserve, you know, over the next couple of months and years, would continue to reduce. You know, because even at 108, yes, 110, 108, where our reserve is 32 billion. It just shows you the level of attrition. Do you understand that we're seeing in our reserve? So what that means in essence is that after a while, you know, you would see that the CBN there have to be some adjustment, and that on its own, in a bid to also cover the adjustment, there's a strong possibility that they might continue to increase interest rates still. You know, they wanted to try and mop up as much as possible. So back to the point made about how it affects our business. I believe it will affect it, you know, but I don't believe it will affect it as adversely as people might think. For the simple reason that what we're telling the state is that look, it's going to a bank and collecting a facility from the bank. Upon the capital market, it allows you to borrow long term being 7 years. That's one. One of the clauses that we put in the instrument and in the bond law is that the state has an option to buy back the instrument. You know, so what that is in essence, yeah, depending on the interest rate, because what you tend to see that should rates drop within the period of its issuance, you know, then what will happen is the state will just reissue to refinance. Now, so but that said, you know, you can't run away from the fact that it will be very, very challenging. And to put it in perspective, I know that recently GTB offered River State, on the back of the announcement that they wanted to do a bond, you know, that they were willing to give, or they have given River State 30 billion at 8%. You know, so even from that perspective, you see GTB is already underwater vis-a-vis the MPR rate. So it shows you that on the back of non-lending on the back of banks, at least in the private sector, banks are willing to take a major haircut, you know, to enter the public sector and the public sector space. But I think the arguments that we make, or we will continue to make, is that discipline that is required to enter the bond market is much higher. The level of transparency because you go and borrow money from the bank, you know, the National Assembly, the people, the citizens of the state, you know, they have no control over how you spend the money. You know, exactly. You know, compared to the capital market, because what you have is that those projects are stated in the bond issuance documents are the projects that the monies must go to. Now, two, one of the challenges that we face, and this is, I think, the strongest argument, is that one, and if you look at it, there's a major problem with the capital formation process in Nigeria today. What you see is that all the money heads to the banks. The money for pension funds, it finds its way to the banks. The money from the management companies finds its way to the banks. The money from insurance companies finds its way to the banks. The money from savings, everything, and even on the back of even this increase in MPR, you see, it's also going to end up going to the bank. Now, what you see is that what it does is that we have a mono source for capital formation in the country today. So what that means in essence is that if the banks don't lend, you know, is dead. You know, for the states, we say to them, you know, that you need to have multiple sources of financing. You need to have multiple sources of financing. Exactly. You need to have multiple sources of financing. And that's one of the reasons why, you know, you sit down with them and tell them, initiate a program. So even if it's 5 billion that you need, you know, you can sit and go to your state assembly and ask for a 50 billion program or a 100 billion program. What that does is that it allows you, should you see an opportunity, you can issue. Compared to a situation where you are depending on the bank, because guess what? Even if rates came down to 6% on the banks, or like in the case of GTB and Rivers State government, what is that on the back of this MPR movement, GTB is going to go back to Rivers State government and they're going to reprice. Now, for a state government that is looking at using that money for long-term financing, they can plan. You have said to yourself, I'm going to use $1 billion every month to service this loan. And guess what? You have a situation where MPR moves from where it was this time last year of 6.25% to 12%. That's a 100% increase. What that means in essence is that your bond service account has to be increased by almost 100%. You can't plan. So I think, to me, at least for us anyway, we think that that's one of the strongest arguments. So back to the point that you raised, Dukwe. I think it will be tough, but I don't think that it would affect the ability to still do those issuances, because really for us, most of the state governments already have some pretty smart commissioners of finance. So they understand the implications that even though MPR has changed, you know, that they are better off, you know, being part of a long-term capital market than a short-term commercial banking market. I don't know. All right. Dario, any questions? Any additional questions? Okay. Okay. Yeah. Okay. Questions, Dario?
None as we speak.
All right.
There's a lot of that I'd love to ask personally, but they have microphones, and that's a little challenge. However, presently there is none. We seem to be done here.
Okay. I wanted to ask, you know, because we're taking numbers, you know. So, Funsho, you had said that you read exchange rate will end up at 160 by December. 165. Okay, so we're more or less, I mean, you're using 165. 165.
Going over 170. I'm going over 170 for the other one.
Okay, inflation. What about inflation? How do you think we're going to end this year? Inflation.
We consistently that we feel that the sort of single-digit inflation situation was either a blip or even artificial. Not artificial on the part of the people preparing it, but artificial on the phenomenon that was driving it. We feel that double-digit inflation will be the situation at the end of the year. It might not be as high as it might not be as high as the 13% that we were looking at mid-year, but it will probably be slightly higher than the 10.3 that it's at right now. So probably, maybe like 11%, 11.5%.
Okay, so I'll take the higher. So 11.5. What about you guys?
I'll do 12%.
So, yeah. Okay, let me explain to you why I asked myself we're going to go back to interest rates on the back of those questions. One, from what I hear you say, inflation rate would average anywhere between 11.5 and 12. Yeah, between now and the end of the year. Exchange rate, an average of 165 and 170. Now, taking that into cognizance, where do you believe interest rates will be?
Prime lending is, I mean, the cost deposit rate is between 4 to 5%. It's about 5.3% right now.
Yeah.
We actually went past. We actually went past that. Yeah. Let's see if we can. Okay, there we go. Consumer lending rate. You can see it's about 4. I think this will stay more constant, more flat. The lending will probably head, since we're looking at inflation slightly higher than what it is now, this will probably go slightly higher as well, back to that 23-24% rate. So that's where I see it. I don't know, Bayo.
Yeah, pretty much like I agree with Funsho, because technically Funsho has not told us that there's going to be a lot of increase, especially at the retail end. At the deposit end, there's likely to be a blip and likely to be sustained a little bit higher than this, especially for term deposit. So if we average out, we could possibly see something that is higher than this, like within the range of 6-7%. Because immediately monetary policy move was made, a couple of banks have already adjusted about those for high volume deposit, and so possibly in that hand. So we see a situation where the cost of funds to bank increased because some of them will have to at interval ensure that they meet the new CRR, as in cash reserve rate, which is now higher, and liquidity position has been doubled. So doing this may make them camp up, for a lot of liquidity from every other place if there are none at some point in time. And you know, most of the liquidity that drives this market at some point in time are coming from FAT, federal government allocation, and NNPC. Unfortunately for them, NNPC money may not be able to go to many of them because they are coming in foreign currency. The net open position reduced to 1%. It will be difficult to accommodate this money. Yesterday, all of
Please explain the significance of the net open position.
The net open position of banks on foreign currencies has to do with how much the percentage of their shareholding that they can hold, shareholders' funds that they can hold in foreign currency, both on their short selling, which is promise those ones that they are holding for long term. Raising this to 1% means that an average bank we have, I can't put a figure, but it actually reduced substantially how much foreign currency position a bank can hold.
What was it before?
5%. Now it has been reduced to only 1%. We saw it in the market yesterday. The interbank market shut down practically because of this. Because no bank would take what the NNPC was bringing, and the CBN had to buy it. Because of this, the total effect is for what the bank has access to at some point in time in terms of liquidity to be constricted, and this will be coming at intervals for the rest of the year, which will make the bank to be looking for liquidity everywhere. So this is likely to push deposit rate a little bit at what we are seeing. But at the retail end, I do not see a lot of change because we have low credit activity, and we've seen a serious inelastic relationship between what the NPR has been and what the retail lending has been, because practically a lot of the demand for credit has been at its barest minimum, and we don't see that changing till the end of the year. However, what this tells us is at the end of the day, the real rate, which the CBN keeps saying it hopes to keep positive, may end up being 0 before the year closes, and that doesn't look good ultimately for people. Yes, the real interest rate.
Okay. So let me just take a cue from there. So let's talk about growth, because we just talked about numbers. Proof of jobs is growth. Let's talk about something real. So all of this, the increase in NPR, how does it fit into growth? you believe that, I mean, there's a good strategy in all this?
I think the growth. I think there's growth. Um, our growth belies a lot of what the monetary system does, largely because the biggest portion of our economy is rain-fed, subsistence agriculture. After that, however, of course, there's also a lot of there's also been significant growth in the non-oil sector pertaining to services like telecoms and trade. So, what I'm trying to say in effect is the trend will continue. We're still going to see GDP growth of relatively modest compared to the needs of the country. GDP growth of 6-7% will continue. What we need to see beyond what the monetary authorities do is for the fiscal authorities, the Ministry of Finance, the coordinating minister, the presidency, the governors, to kind of practice in terms of their taxation, their debt structure, their spending, that will stimulate A, activity, and B, perception to accelerate that growth. If any positive or constructive action is taking place, or some of the pronouncements are backed by action, for instance, if fuel subsidy is removed and money is channeled to structure that brings about
employment. For sure, the first one is not going to happen between now and the end of the year.
Okay.
And so, and what we're talking about,
you're talking about
between now and
the end of the year.
You know,
I think between now and the end of the year, we're just going to see momentum, and the momentum is that 6-7% GDP growth will continue. It's not because of anything that the monetary or indeed fiscal authorities do.
Projections for this year, the outlook for the economy for this year to be 7.87%. Just a little bit of thing. This is point difference if I missed the point. And thus far, this is as at the second quarter report, we are doing pretty well. We're on course. And this is quote the MBS figure. And technically, according to the monetary authority and their report, it is obvious that the type we are seeing so far has not distorted in any manner the growth projections of the economy, and it is not likely, really because of the reasons that Funchoke had just given in terms of the base drive of the growth that we estimate. If those dimensions come to pass, good enough for us, then that means we could actually double the growth figures we are seeing. But what happens to what is happening are some other indicators of growth which will be very much interesting to all of us to see. What about the number of jobs that have created? What is the level of unemployment in the economy at this point in time? Maybe on a monthly basis that could be helpful. What is the level of activity in relation to the manufacturing capacity utilization? What is happening to amount of output, manufacturing output month to month? And what is happening to the dynamics of trade in terms of retail activities? All this could help us to know whether the tightening is hitting us in where it should be hitting us. And unfortunately, we don't have this statistic. I'm very sure some of us could ask ourselves and say what we see around us. If it is really true that the growth of 7% is being impacted directly by the tightening or not. However, it's important for us to know that credit is not growing.
Thank you. See, for me, and for sure you probably know that I argue all the time. I mean, we have those GDP figures, and as far as I'm concerned, I believe that there's no correlation. Cannot have a situation where there's little or no credit. There's little or no credit in the system, and you say that there's growth. From where? Where is the growth coming from? I mean, I'm not Bureau of Statistics. That's where the information comes. But I'm just saying, it's just if you follow the logic, it doesn't make sense because the banks are not lending. The capital market has its own arising issues. So where's the growth coming from? 60 million people, 22 million of those are unemployed. So where's the growth coming from? So I mean, the CBN and bureaus as they really have those numbers, but I have my own concerns. Anyway, I mean, let's. I think we should just pause. We should leave Nigeria for a minute and let's just come home as in BGR and let's look at how the MPR and the actions taken by the MPC Monetary Policy Committee, how it affects us, in terms of our business, and also from a strategy perspective, how we would come up with new strategies, to more or less get around this. We spoke about the sub-sovereign issuances based on the question that Dr. has raised. But let's talk about the equities market first. So as an institution, what is our take on the equities market between now and the end of the year?
Like we said, I think it was during the webinar with Henry. It's about uncovering for the equities market, about uncovering value, telling our clients where this value exists, and of course for own portfolios as well, where you have farm mills with single-digit forward Ps, bank, GTB. There's value to be had.
Okay, hold on.
Okay.
Let me just pause for a minute so that at least we can also put things in perspective. One of the things that we seen was that what fueled the rise in the capital market, and took the index to the astronomical proportion that we saw was credit. The availability, margin trading. We don't have that. The risk space has its challenges. Now, so if going to be any growth in the capital market, where do you think is going to come from? Now, what I'm saying is, and I want your response to be directed, so that for our colleagues that are out there and are going to hit the road, so they know the segmented markets that they should go after.
Absolutely. I think it will have to start with our local institutions. It has to start with the PFAs, the insurance companies, and other firms that have pools of money that are not properly diversified. I know, given the current trends in the bond market yields, there's going to be even greater propensity to invest in that direction. But I mean, all it takes is a little bit of common sense, really, for these fund managers to realize that if they throw even money at FG bonds than they already have, they are also increasing. Okay, all right.
Hold on a second. The question is on equities.
Yeah.
The question The question was on equities.
No, I'm going to go there. It's for us to tell them they need to diversify. They need to take cognizance of value. They need to participate more in the equities market. And I feel that the drum is being beaten. It's been beaten for the last month or so. It is just a matter of time before we have a turnaround. It might not be as significant as we want, but there's no this value with GTB giving virtually double-digit dividend yield, that the market will remain as it is. It's an anomaly, and it will be corrected, just like the over-the-top high prices were corrected.
Everywhere in the world, that is prior to the current trend globally in terms of the financial volatility, equities are actually supposed to deliver high yield that is not the largest, not comparable to what you can get from the safe haven. However, the situation has made investors really all over the world about where they want to keep their money, and their experience being tough as it is. For market, we understand the fact that, as Funcho said, there is value. Then the only problem we have is confidence. To a large extent, it is the perception of policy direction and the risk environment, security environment, that is making investors to a large extent jittery. Retail investors really were never the drivers of the market in the first place. The market, according to the statistics that were made available by the market, are foreign investors who are controlling over 60% of the market.
So that's an abnormal situation. It's abnormal because you see, locals are not. Sorry, is that because the locals are not investing? But if the locals are not investing, what you tend to see is that if $1 came in, that $1 represents a large part of the market. You don't say that yes, but it's not a statistic. Because what you have is that you have local institutional investors, Funcho is right, that are there that are present but are staying away from the market. So you have that they are distorting the market. Yeah.
Well, some of the reasons for those local investors are more are policy driven. The pension system, for instance, now could not do much that they are doing then. I don't know today because their guideline does not allow them to
I don't agree with
should
you.
be changed.
I don't agree. Yes,
However,
because see, right now, pension funds, the maximum that they can do in the equities market is 25%.
Yeah.
The average is 8%.
And
Average
because of the
exposure.
situation I just mentioned, because of the perception I just mentioned, because of the policy direction, many of these guys understand the fact that there is value out there. Yet, they're not ready to put their legs in the water. Why? And my position is fine. For foreign investors are not likely to stay. But if we are going to begin to reflate this market, that is likely to be the direction where we reflect
For the foreign market,
fueling coming from.
Now,
Given the way
I don't
we are
on that one.
now, if we could have a policy environment that begins to look positive, that begins to look like 10-year, my 2-3 year exposure to this market is going to turn positive for me, then the likelihood of the market propping in the positive direction becomes a little higher.
No, but
is for
sorry to interrupt you. I guess maybe because we have economics left and right. Let's try and situate it. One, historically we've seen that what actually chases inflation is real estate and capital markets. Two, they also factor in whatever change in interest rates that you see. So what that means in essence, if the fundamentals of the companies are strong, typically they are a guard against inflation. Do you understand? To ensure that you mark to market against inflation. Typically, people should be in the market. Now, why I stopped is that so that at least I can make a more or less like a policy statement to staff of BGL that are listening, is that we need to be at the foot of those PFAs, the institutions, because typically follow the cycle of investment in any market. The way it flows is that the local institutions come first. They own the risk, they've been longer, they come first. And then people that follow are the HNIs. Because now some of them have financial advisors that advise them, or some of them are in industries some of these industries that they understand very well. So it makes it much easier for them to actually come in because they already understand the market. And the retail guys come in. Now, the last set of people that are coming in this market are the international. Because nationals look at all this, the internationals look at all these people because when they want to come in and they find that the locals are not investing, then they're asking something must be going on. So what that is, so I can have a situation whereby valuations are almost at rock bottom, or if not rock bottom, because we've seen a situation where the market has broken the 19,000. It's now 19,000. The index is now 19,000. So clearly, lot of value. Now, for us, we must ensure that yes, we agree that confidence is low as it pertains to a lot of these institutional investors, but it can only be for a while. At some point in time, everybody is waiting for who's to jump in first, who's going to jump in first. But once that first guy jumps in, what you will see is that head effect will continue. So from a strategic perspective, we must be as close to them as possible. We need to be putting research information in front of them. We need to be talking to them about the market, letting them know where we see the market and how we see the market will end. Because at some point in time, the investment committees will take that decision and get them to invest. We want to be that firm that is there when they take the decision. We don't want to be we heard that Mr. X pension fund is investing. Do you understand? And my rush my then is already too late. So I just thought I should make that valid. But we're talking about bringing it home. So that's the equity market. What about GCM? I know I spoke about GCM, but let's on the back of also the comments that we've made and being able to think it through. Do you have any ideas or comments on GCM?
I guess because there's that overall surge in liquidity, which will continue because of the system we have in the short term at least. I think the liquidity will be made available once we adjust our GCN rates appropriately. Major challenge, like you said, will be how to trade to make sure that we get returns in the short term that will give us probably 25–30% at the very least to be able to service the GCN monies. And it just strongly tells me that outside our bread and butter equity market, we're going to have to look at new markets, starting from the bond market, even more exotic markets like commodities, maybe even forex, maybe real estate. Real estate short term, we have to look for those, say, commodities, really.
All right. Okay, so I wanted to ask one question. So, your take is that on the back of these new developments, you see, should we be looking at significant growth, in our GCN?
I think there will be, depending on we'll probably have to have a committee to decide the rates. But if we adjust rates accordingly, I think there will be significant action in the money market, as it even beyond whatever activity, heightened activity will be in the bond market. So yes, there's definitely an opportunity there.
And I totally agree with you, because I was just looking at your numbers once again. On the back of the fact that most banks, as we go closer to financial year end, because most banks, their financial year end is 31st December. Most of them will not be looking at giving out new loans because of the 10%, 1% provisioning that is required by the CBN. So there's no point doing that and give 1%. You have to take a 1% haircut. So what you would see is that a lot of them will be looking at investing in instruments, rather than actual lending between now and the end of the year. That's one. Two, so what that means in essence is they will try to keep their deposit rates low, so that they can continue to maintain the spread that they've always had before now. So what it means is that it definitely creates an opportunity for us to grow our GCN, because based on even the current rates that we have, there are rates that are even much higher than the kind of deposit rates that we've seen in the banks. So I agree with you that clearly, there is significant opportunities to grow our GCN and our Sapphire Fund within this period.
There's a question.
Yeah.
There's a question. Hey, can you hear us?
Yes.
Sorry.
Yes, I hear you. This question is from Akindele. He says, is there a way that BGL, perhaps by virtue of its market-making capabilities with the NSC, can compel multinationals and corporates to be listed on the market? For example, MTN's profit after tax last year was about 770 billion, and they are listed on the floor of the stock exchange. How can we be compelled, maybe working with the regulators, to get them to list on the market?
Well, that's a good question, and right now that's already happening. It's one of the items that is being considered, or being put on the table at the presidential retreat that is ongoing. Through some kind of soft persuasion to try and get the multinationals, the MTNs of this world, the Glos, the ExxonMobils, to list on our exchange. Although, taking that into cognizance, I also still have my concern. My concern is that if I have to list, typically, like if you look at MTN's financials, they don't need money. They have a lot of cash. MTN has a lot of cash. So if they have to list, it would be listing by introduction. They would have to sell 25% of their current holding to the market. Question: does the market have the absorbing capacity to buy MTN shares at the kind of valuation MTN, we want to put to the market at this point in time? I don't think so. It's a catch-22 thing. Yes, you want to push them, but they will come back to you and say, guess what? Okay, so I want to list at 300 naira. The market cannot absorb it. So one of the things, because I was also luckily, I was also privy to be part of the new rules, part of the committee on the that was part of the exposure of the new rules, and also to comment on the new rules as being proposed by the Nigerian Stock Exchange. One of the things that's being proposed to address that issue is a situation where a company like MTN or one of those guys will be given an opportunity to slow down over a period of like 3 to 4 years. I don't think we've actually quite decided whether it's 3 years or 4 years or 5 years. So what I have is that yes, you can compel an MTN to list. You know, it might list with maybe 3% or 2%. Over a period, they'll build up to that 25%. That's one. Two, the stock exchange is also willing to waive and say that the rule should state that the 25% in question is 25% of shares held in public. So if you have a dual listing, you know, if 25% is really held in public hands, then you also fit into that rule. But just an answer to your question. You know, clearly, I think it's a fantastic point. I think it's a major market recovery strategy. You know, we also have to be careful. You know, because if we have MTN, Glo, and the market right now, as we speak, at the kind of valuations those guys want to sell their shares, I don't think the market can absorb. The market can absorb it. That
Well, that's the only question I have now. So
okay, yes. So just to wind, like I think we had already done that. You know, we're saying where do we see market trending? You know, do you believe that NPR will hit 15% from time in a year? Funcho, what do you think?
I would say no. I mean, I would agree with Bio, but not as much conviction as he seemed to. But the truth of the matter is that because I was speaking with the president of the FMDA yesterday, from all indications, the monetary authority, the CBN, is ready to do whatever it feels within its own narrow focus it needs to do. A, to protect the naira. B, to pursue its inflation targeting regime. Is ready to undermine really the government's propensity for local borrowing. It is ready to somewhat back economic growth factors if they feel that is necessary to keep inflation tamed and to keep the naira relatively stable. So I would say yes, but much more grudgingly than Bio did a few minutes ago.
What about you, Bio? 15% MPR by the end of the year.
Well, I'm going to maintain my position. That we have only one MPR that is looking us in the face. I agree with to ensure that the
You can call another emergency.
Well, of course, they call it other emergencies, quick, of course. But where I agree with him that the CBN is ready to go all the way out to maintain price stability, which is the ultimate objective. There are a series of instruments they could use to do that, and it's obvious that despite the fact that he's ready to do anything, it's not going to kill the economy totally. It's not going to go to there's always a tipping point to everything, and I'm sure that getting to 15% in another one MPC or 2 MPC will be a tough despite the aggressiveness. And considering the fact that you are going to begin to pump a lot of money into the forest market, it shows that it will be considering alternatives. So there's likelihood that we'll get to 15%, but there's likelihood that there will be more tightening.
Okay. Just a final question before we go. Do you think that ever come back to the single-digit interest rates of 16.25, like 6.25, like we had?
I really don't think so, because I mean, on the one hand, you're looking at benchmark government rate being so high to curb liquidity. On the other hand, even if the fiscal authorities and the economic management authorities get things, so to speak, we're going to have economic growth. The economic growth itself is going to drive inflation. It's going to drive interest rates. So we're going to have to deal with in the mid-term 2-3 years double-digit interest rate regime, and how to top that in terms of we as investment bankers giving investors a return for their money.
Totally agree with Funshaw, because we will have to see another global recession, so to say, for us to go back to a expansionary monetary policy where rates in Nigeria are going to go to the floor, and that will include the fact that economic growth is threatened. And for now, as it is, every positive development that's supposed to follow this increase are likely to yield more growth, as they are said, and more growth are going to be pushing inflation, which higher interest rate is supposed to curb. So obviously, it will be a tough call in the foreseeable future to think that the interest rate, at least the benchmark, could begin to recede again.
I guess so. What you guys said, that's wishful thinking, so to speak. Okay, the question just came in from Oluyomi Oluyede. I think we'll just take that before we go. He had asked, as the exchange is trying to introduce exchange traded funds and securities lending, how that affect the market recovery. How that affect the market recovery. Once again, you have a situation whereby funds, even though positive, is a new instrument, and with new instrument comes people's learning curve. Nobody in a market that people are actually looking for clarity would they invest. Do you understand? Jump in and reinvest in a new instrument, no matter how informed they are. Earlier on in the day when we were discussing, you have a situation where the local institutional investors who understand this equity market, who have played in this market for almost 15 to 20 years, are still not biting. They're not coming into the market. So you can imagine a new instrument. So it's a positive development for the market, but in terms of would it play a major role in market recovery, I don't think so, at least right now, within the next 6 to 12 months. I don't. That's on exchange traded funds. On securities lending, I think it's positive, but you see, securities lending is more for a bullish market. It's an action for a bullish market where people want to buy, but they can't find enough security. So yes, all of this is good and it's positive. They are all positive actions to take in anticipation of the bull run, but would they play a major role, in terms of market recovery? No. What's even more fundamental in terms of market recovery, I think, if you ask me, are two things that we need to get off the ground. One, the sub-fund, because by the start of the law, the sovereign wealth fund can invest in quoted investments. So they are allowed to take strategic stakes in quoted investment as long as it has significant development impact, in the nation. So we can get the sovereign wealth fund off the ground, get the governors to jump on that bandwagon. I think the better for the country. And then, of course, the issue of the pension funds, 2 trillion in pension fund money, and we have a situation where a sizable amount of that is meant to be in the equity market, and it's not. Their members has 25%, most of them on the average at 8%. So that's roughly about what? That's roughly about they almost triple it, and so you can imagine the kind of impact, and that will have. Okay, we're being told that we've maxed out, but I'd like to use this opportunity to thank those of you members of the audience that have been part of it. It's remarkable to see that we have almost 67 people tuned in, and also for the people that have participated, Funshaw and Bayo. It's been a very, very lively and interactive forum, and we look forward to continuing. Thank you very much. Of course, the guys in the background now we don't see, Dari and Co. Very much. Yeah. Bye-bye.
Dari, can you use this mic? Can you use this mic?
Mr. Mike, Mr. Okay. Thank you very much once again to everybody that has participated in this session. Once again, you have to remember that on the 26th of October, we have the DG of the NSC coming to this podium to discuss some interesting things in context of lifting and directions that the market is going to go. Please make this a date. If you had some IT challenges, please get back to us. To end this meeting, there shall be a survey. Please fill the survey accordingly, and we will treat accordingly. Thank you for your time. Hope to see you next week. Cheers.